Hello, and welcome back to another video. In this video, I'm going to be going over sectors that I believe will perform well in the next year and also, of course, in the upcoming years. Now, before we get started, this is my YouTube channel and I post different types of videos, including things like educational videos about the stock market and also stock picks in themselves. So, if you like this video, then you probably will like other videos. But just one second, before I continue into this video, what is your favorite movie? Right now, I just watched War Dogs, and to be honest, man, I really like this movie. I don't know why I haven't watched this earlier. Having these two actors in one combo was really funny. But tell me in the comments, what was your favorite movie that you have watched recently? So as you can see, AI and data centers require power demand and it needs lots of electricity. And really the bottleneck for AI and data centers is actually electricity, not the GPUs. A single AI center can take 100 megawatt, equivalent to an annual use of hundreds of thousands of EVs. This is insane. Global impact, the data center consumed 1.5% global electricity in 2024, but this is growing rapidly at 12% annually. So you see how this is going to be even more in demand when people start using AI in the future as well. Now AI is not just powering our ChatGPTs, it's also powering autonomous vehicles. Tesla, for example, they use AI. Waymo, they use AI. So AI is not just something that me and you use. AI is used everywhere by different types of industry and different types of companies. Now, the key drivers for this is training large language models like ChatGPT, and complex AI models require immense power from powering GPUs, CPUs, and TPUs. Now, you can see how this market is still going to be growing massively because of AI. And for this, I have two stocks that I think are going to do well for this sector. The first stock I want to talk about is Constellation Energy. Now, something that I also want to point out that Constellation Energy has signed separate long-term power purchases agreement to supply nuclear energy to Microsoft and Meta platform to support their AI data centers. So they're already partnering with trillion-dollar companies to help with energy consumption with their data centers. In June 2025, Constellation Energy and Meta signed a 20-year power purchase agreement for the entire output. You have a rating of 3.21 out of 5, and we go over this. Constellation has negative free cash flows of negative 276 million, which means it is currently losing money. However, it has grown revenue at 3.58% over the past year, which is as sales are increasing. The profitability margin is 44.95%. Their operating margin is 13%, which is an average. The return on invested capital though is 13%, which is I like to see above 10%. Now where the rating drops is really this part, where the PS of 4.53 is above their 4-year average of 2.2. And also their OCF risk premium is at 0.52, which gives it a bad rating. I really think that the company is nice, but their financials do not look that attractive. Their CAGR is growing at 2.4%, but this could dramatically change in the future with more companies signing deals with Constellation Energy. Their cash flow has also decreased into a negative territory, which is I don't like to see this. I like to see high cash flows going up to the right. Their gross margin is 51.5%, and their operating margin is sitting at 18.6%. Now, I like the company and I like the idea. I think in the future it might benefit. I think it's a wait in the future to see how it performs and how their financials could flip, especially with the deals that they signed with Meta and Microsoft, and how this could increase their revenue, and how also could other companies partner with them. But also one thing to point out is their net income has a CAGR growth of 42%, which is insane. You can see that they went from 443 million to 3.7 billion in just about 7 years. So their net income is growing, but their cash flows is decreasing. You can see that their cash flow started decreasing from 2018 and they just started going downwards from after there. But they are going a bit up, so you never know. Maybe in the next few quarters, their cash flow could turn positive, and that could be a good sign to enter. Now, the next stock I want to go over is GEV. GEV is also in the energy sector. While CEG provides the power, CEG provides the grid hardware. If the grid can't handle the power, CEG can't sell it. Therefore, GEV is sold out of transformers and turbines throughout 2026. So you can see how the demand is incredibly increasing. Their PE ratio is at 105, and their forward PE is at 60, which is a bit too high for me. But let's see why they have a 3.45 rating out of 5. GEV has grown its revenue at 9.44% over the past year, which is as sales are increasing. However, it has a gross margin of 19.69%, which means it is not able to deliver its product service very profitably. As you can see, this is very bad compared to the sector that they're operating in. Another reason their rating is down is their operating cash flow is decreasing, and as well, their free cash flow is decreasing. Their free cash flow risk premium, their free cash flow yield, and their PE of 105 is extremely high, indicating potential over-evaluation. Their price to free cash flow is at 72, is also extremely high, indicating potential over-evaluation. So I think the stock is overvalued right now, but I'm not saying that I might not win for this upcoming year, especially with data centers and the energy consumption. You can see it already went from 289 to now sitting at 663. It went up its price. It's trading at its high 52-week range. I'll be keeping it on my watch list. If it goes down and the revenues kept increasing, so as their free cash flow and net income, then it might be a buy for either 2026 or even moving forward. Now, this is the last stock that I want to talk about in the energy sector. Now, again, their financials could look terrible, but that's just in the early cycle margin recovery story. The current reality is their margin is still recovering, their past execution issue is in wind, and their capital intensive manufacture. The reason why they don't have bad financials is because their order backlog through 2026. And also, their transformer shortage gives them pricing power, which is good to see. Their cash flow inflection is underway, it's not theoretical. This is a post-spin around in the middle of a global electrification bottleneck. So really, the financials are early cycle, not that bad. So because these energy companies sometimes are cyclical, it's often hard to evaluate, and they might just be going through a cycle, which is what I see with GEV and CEG. It's also good to know that this is not financial advice, and I'm not telling you to buy right now. But I think in the future, it should be on your watch list, because energy consumption is only going to increase from here. But I would like to have a deal and get a good price on these stocks, especially Constellation Energy, as it's in more of my circle of competence. So I'll be adding these stocks into my watch list, and if the price drops, and like I said, if their financials look good, then it might be a good entry. Now, the next sector I believe that could also outperform the market next year and moving forward is the aerospace sector. Aerospace and defense is a growing sector right now, especially the defense sector. But for this sector, what I try to find is more of a monopoly. Something like how ASML is a monopoly for the semiconductor market. And for this, I would pick this stock. TDG is an absolute monopoly. There's so much of a monopoly that sometimes they're facing some backlash of how their pricing is. And I'll go over this. Now, before we look at TDG, I just want to mention that the aerospace sector is booming because of a simple problem. Boeing and Airbus cannot build new planes fast enough. So this forces airlines to keep old planes flying longer, which requires constant parts maintenance. And this is where TDG really shines. The company recently upgraded its 2026 outlook. It expects 9.85 billion in revenue with EBITDA margin of 52.3%. These are software-like margins in a physical manufacturer business. And this is because they own absolute monopolies. Meaning, when you fly in an airplane and you have your seatbelt, yeah, these seatbelts probably are made by TDG. Not physically made, but TDG acquires small company manufacturers in the aerospace industry where it creates a monopoly in the pricing power. And the thing is with airplanes, that if an airplane is made and they chose TDG as their partner for these small things, then they cannot change it for the next 20 to 40 years. This means every year they need maintenance, or every need they need any replacement, they're always stuck with TDG. For them to change it, they would need contracts that would cost them lots of money and also approvals, which is at the end not worth for the airline that's trying to replace. 90% of their products are proprietary. They are also often the only company authorized to make a specific bolt or valve for his aging jet. They have a rating of 3.6 over 5. The analysts are good, which means they have upside. Their management is good as well. Their valuation is average. Their profitability is very good. Their financial health is average, and their growth is good. So you can see this is better than what we saw last time. Their gross margin is 60%, which is good. Their operating margin is 47%. Now you need to take into account that they're selling hardware products, correct? And they have these types of operation margins, which is almost like software margins. And now this is pretty good to see. The return on equity, though, is negative 19.6%, but also the return on invested capital is 21%. I like to see this again above 10%, so this is good to see. Their operating cash flow is decreasing, their free cash flow is decreasing, which why it gives it a bad rating. They have a free cash flow risk premium of 0.59, which gives it a bad rating as well, and their price to free cash flow of 40.6 is extremely high, indicating potential overvaluation. They have a revenue growth CAGR of 12%. Their free cash flow is sitting at a 12% CAGR as well. Their net income is sitting at a 15% CAGR. Now, this is one of the stocks that I like in the aerospace because it's actually a true monopoly when you look at it. They're not trading at their absolute lowest 52-week range, but they're getting there. But to be honest, this company has the strongest financial profiles in all industry because their actual numbers is their EBITDA margin is above 50%. They also have a free cash flow conversion consistently above 100% of net income. The return on invested capital is above 20%, which is good to see. I like to see that above 10%. And not to forget, this company has an absolute pricing power that airlines openly complain about. TDG runs a private equity capital structure inside a public stock. Their debt is intentional, stable, and serviced by recurring aftermarket cash flows. This is not financial weakness, this is leverage discipline. Now, the next sector that I want to talk about is applied AI and software. Now, when you think of AI, AI has been changing the world recently. But I think in the upcoming years, companies will actually start to notice their productivity increase. So therefore, they would adopt more companies that have AI workflows. So applied AI and software is about taking AI technologies like machine learning, NLP, and computer vision out of research labs and embedding them into the real world application to solve practical problems, automating tasks, enhancing decision making, and creating intelligence feature in everything from a chatbot to medical imaging. Now, something like automation could increase companies' productivity and save them so much time. And this is where ServiceNow comes in place. They are aiming for a 15 plus billion revenue by 2026, which is an insane amount of revenue. The company has AI agents and workflows on every side of the business: IT, risk and security, human resource, and app development, finance and supply chain, and CRM. Now, lots of big companies use ServiceNow, like Walmart, Amazon, Apple, and big names like Adidas, Microsoft, Dell, PwC, and NASA. And the reason why you see lots of big companies that are in different industries is again because ServiceNow is diversified. They have different products and because of that, they have big companies from industries like retail and tech, financial services, healthcare, manufacturing and consumer goods, telecommunication, and government and aerospace. So just so you know, ServiceNow did a stock split of 5-for-1. ServiceNow is a company that I am personally looking at and I'm thinking of adding it to my portfolio. They have a bad rating for two things: their management and their valuation. But going over the actual company, this is a company that I really like and I'm thinking of adding it to my portfolio. Their forward PE is a bit too high for me, so I think I'll be waiting a bit for it to drop. They have a 3.5 rating. The gross margin is 78%, which is very good. Their operating margin is 13%. It's an average compared to their industry leaders. Their net margin is also an average. Their CBC as percentage of revenue is very bad though, which is why it has a bad rating for management. But their return on invested capital is 12%. Again, I like to see this above 10%, so this is good. And really why I always focus on the return on invested capital, because this is one of the most important metrics for me. It shows me how management is good in allocating money and how much of a return can they see from the money that they invest in the company. As you can see, their growth looks nice. Their revenue increased, their operating income, everything is increasing and looks very good. Their shares are increasing though, which is an average. Their free cash flow risk premium is at 0.59. They're growing a revenue CAGR of 30%, going from 2015 from 1 billion to 11 billion. Their free cash flow has a CAGR of 35%, but when you look at quarterly, you see how sometimes it's a bumpy ride. They also have low debt compared to their cash, which is good to see. Most analysts consider this a buy, with an average target of 231, which is 50% from here. Now, one thing to note is that you should not trust price targets because sometimes they could be misleading. So ServiceNow is something that I am monitoring and I would like to dig deeper into and see this how it could complement my portfolio. Now, of course, if I'm speaking of applied AI and software, then I have to consider Microsoft as well. As you can see, everything for Microsoft looks pretty good to me. Their gross margin is 68% and their operating margin is 46%. I really don't need to go over Microsoft because we all know it and we know how good of their financials look like. Microsoft is a company that I personally hold and has always outperformed the market. It's a company where it's steady, it's a company that has low risk, but it's such good quality that I love to own in my portfolio, and I think no one can go wrong with this. They also have workflow automation tools for enterprise customers, but I see this a bit more than ServiceNow, and that's because ServiceNow is more of a vertical business type where they have solutions for their supply chain, their finance, their CRM, while Microsoft have workflows in general. And also, not to mention, Microsoft is embedded in every company and they really have a sticky business where it's very time consuming and costs money to change from Microsoft to something else. You can see this is how their workflows look like, but by far the most good thing about it is that you can just describe what you want and Copilot is going to build it for you. So it makes it easy for almost any enterprise company that is not tech savvy to use these workflows. And lastly, the last thing that I want to say for Microsoft is their large investment in data centers will start to roll off, meaning they spend less on building and start collecting high margin rent for AI users. Now, the next sector that I also think will perform well next year is autonomous vehicle. In the autonomous vehicle space, you have lots of competitors. You have Waymo, you have Tesla. These are the Waymo cars. As you can see, it looks a bit expensive. I think this car costs around 200,000 to make. So in case you didn't know, Google actually owns Waymo. So if you want the autonomous vehicle exposure, Google might be it. Its forward PE is 28 and its current PE is at 30. Now this is actually expensive for Google. It usually trades around 21, 22. They have around 4 out of 5 scoring. The only thing that makes it look bad is their valuation. But of course, as we know, Google itself has good metrics. The gross margin is not 59%, their operating margin is 32%, the return on invested capital is 25%, the revenue increases by 13%, operating income increased by 14%. All the metrics look good. The only thing that's giving bad rating is their valuation. Now, I personally think Google is not that expensive. I think it's near fairly priced to getting a bit of expensive, because with Google you have lots of catalysts. You have the autonomous vehicle and also you have Gemini. Gemini has been the leading AI model, taking over ChatGPT right now. So basically you're getting two types of things. Also you have YouTube. By far YouTube has no competitors, and that's why you're watching this video. If YouTube crashes, you cannot find another competitor to watch YouTube-like videos. So I think Google is one of the great companies, right next to Microsoft as well. And their valuation right now is getting into the expensive to fairly valued territory. It's not undervalued like it was here, but it's more like fairly valued. Now next we have Tesla. Tesla is a stock that I do not recommend buying at all. I think the stock itself might do good, which does not mean that you need to buy it, but I think at these prices it's insane. A P ratio of 300, a forward PE of 259. You have a bad rating of the management, their valuation is very bad, and their growth is bad. I also think that their growth is bad because, as you can see, the revenue has not increased from 2023 and 2024. It looks like they're actually being flat or going down a bit. The net income has also went down, and same as their cash flow. Their gross margin is 17.8% and their operating margin is 7.9%. But I know this is going to piss a lot of people. I actually don't like Tesla and their valuation right now. Their financials do not look healthy at all. I don't like that as you can see, their margins are decreasing. Also, Tesla has promised 1 million robotaxis in 2020 and it's 2025. And we're not near any of this. So Tesla's financials do not look healthy because I see that their gross margin and their operating margin are decreasing, their net income is decreasing, their cash flow is decreasing, and their revenue is also flat. Yet they're trading at a 300 PE. I mean, look, Elon Musk is a marketing guy. He knows how to market Tesla so well, and that's the reason why they're trading at a 300 PE. No company that's revenue is decreasing and all these metrics are decreasing and would be trading at a 300 PE. Except Elon, because Elon Musk knows how to market Tesla. Now, if you hold Tesla, you can continue holding it. But if I'm buying it, I would not buy at these levels at all. If I'm buying Tesla, it would be much cheaper than that. I actually don't want to say the price because I think I'm gonna get hate comments if I say the price, but much lower than that. Tesla could perform well this next year because of robotics and because of autonomous vehicles, but it's not a stock that you should buy. Now, a stock that you would not think I would talk about for autonomous vehicles, but it's actually Uber. Uber does not have a single car or does not build cars, which that's a good thing. That's what makes Uber an asset-light business. But Uber has partnered with 20 plus autonomous technology companies across the whole world. So if you think that Robotaxi or Waymo is going to do good in the USA, well, what about Europe? What about China? This is where Uber comes into play because Uber is partnered with companies from China, companies from Europe, companies from all across the world, which makes it you as an investor, you don't need to bet on a single company to win the autonomous vehicle route. You can only have Uber, and Uber is diversified with 20 plus partners. So if any company wins, you're still winning. And also, Waymo is also itself partnered with Uber. And as you can see, so much more. Uber's current PE is 10, but its forward PE is 24, which is still good as well. I mean, Uber has a 4 out of 5 rating. It's among one of the highs that we saw this video. Their management look good, their valuation looks very good, their profitability look good, their financial health look good, their growth could look good. So you see how Tesla's compared to Uber, the gross margin is 34%, their operating margin is 8%. I mean, I would like to see this higher, but that's not terribly bad. The return on invested capital, however, is 46%. This is amazing. Their revenue increases by 18%, their operating income increased by 49%. Now, if you compare these two Uber and Tesla, you see that Tesla is at 2.7 out of 5 rating and Uber is at 4 out of 5 rating. And we can read it here. Tesla has grown margins of 17%, which means it is not able to deliver its products and service very profitably. Also, it has seen its revenue decline by negative 1.5% over the past year, which means the company is losing sales and customers. While Uber, on the other hand, has grown revenue at 18.2% over the past year, which is strong growth. Also, it has free cash flow margin of 17.4%, which says the company is very profitable. I mean, look at that. Uber's return on invested capital is 46%, while Tesla's 7.2%. But anyways, that's enough of that. Uber's revenue is still growing at a CAGR of 40%. Analysts say it's a buy, and I personally think as well it's a buy. And that's why I hold it in my portfolio. I think Uber is one of the companies that are feared with autonomous vehicles, and it reminds me just as Google 1 year ago, no, Google 6 months ago was hated and feared by AI as it's going to be disrupted. But I think actually Uber as well is going to have the same comeback as well, because they're partnering with autonomous vehicles. They don't need to own a car, they don't need to manufacture the car and not be an asset-light business. That's what I love about Uber. And for this, I think Uber either next year or even the upcoming years, when investors and especially Wall Street start to realize that Uber is not being dead because of autonomous vehicles. The only thing that's being changed here is the driver, not the actual business. If anything, autonomous vehicles actually is going to make Uber margins even higher. And when I say robotics, most people do not think of Amazon, but I think of Amazon. Amazon has a lot of robotic systems across their warehouses inside. Their financials also look good. They have a 4 out of 5 rating. Their forward P is 30. Their gross margin is 50%. Their operating margin is 11%. And not to mention, Amazon is also a cloud business leader with AWS, and that's the reason actually why their margins are getting higher, because before they were 2%, but with AWS they started to increase even more. Their return on invested capital is 16%, return on capital employed is 14%. Revenue has increased by 11.4%. Amazon's revenue has a CAGR of 21%. The company looks very promising with their AWS and cloud computing and also the robotics, and not to mention as well, they have Zoox, I don't know if I'm pronouncing correctly, which is also an autonomous vehicle. Now, this is not your average autonomous vehicle when you think of autonomous vehicle, because Zoox is operating in a different type of style. They're more around the city where the maximum speed is like 50. This is also a purpose-built autonomous vehicle for transportation. And I see with this, they can also use it with delivery, where they don't have to have drivers and they can have autonomous vehicle delivering delivery. Now, this is going to look very different because how are they going to drop the boxes? And I think Amazon with the robotics and their R&D, they're going to be able to come up with a solution that will be able to deliver packages using autonomous vehicles. Now, if I was going with the robotics play, I would just choose Amazon, to be honest. Now, next year, I believe that fintech could also perform the market. The first stock that stands out when you talk about fintech is SOFI. SOFI is trading forward PE is 48 and their current PE is 53. Their valuation is very bad and their financial health is rated as also very bad. They have a revenue CAGR of 43.2%. Their return on equity is 7.29. The return on tangible equity is 8.9, and their SBC as percentage of revenue is 7.8, which is rated as bad. But all their evaluation is rated as very bad. Their price to sales of 10.27 is above their 4-year average of 6, as well as their earning risk premium, their earning yield, and their PE of 53 is extremely high, indicating potential overvaluation. I also personally think that SOFI is a bit overvalued right now. The reason why the stock is down though is because they issued shares, and they issued shares like 2 weeks ago, when they also issued shares end of August. Now, to do this 2 times in a span of 3 months, I don't know. I don't like this management style. I mean, right after the stock went to 32, they issued shares. The last thing I want to go over is these systems. I'm sure everyone has seen these systems, especially in a restaurant. For this place, you only have basically 3 players: Toast, Clover, and also Shift4. Now, Clover isn't a publicly traded company. It is a POS system that is owned by Fiserv, but there's also Clover Corporation, which sometimes people get confused. So remember, Clover is not publicly traded. If you want to buy Clover, not financial advice, you can buy the stock by buying the ticker FISV, as it owns the POS system. Now, this sector is a sector that I'm monitoring, and I think this sector is tied with consumer spending. So this could be a volatile sector if you invested in any of these companies, and if a recession comes and consumer spending decrease, which means restaurants won't be seeing lots of customers. But also you need to remember that most of these Shift4, Clover, and Toast, they operate in a subscription-based model, meaning even if a restaurant has few customers coming compared to last month, they can't just cancel their membership because they would lose their point of sale system. So this sector I'm starting more to research on, especially looking at Shift4 and Toast. But I think in a way, which is, I know it's a bit different, but they remind me of Microsoft. No company is just going to be like, let's cancel Microsoft in a recession, or let's cancel Excel or reduce our subscription just to save money. The company will not be able to perform. Therefore, I think it's the same for Toast as well. No restaurant is going to be like, let's cancel Toast because there is a recession or because I need to cut on spending. They would lose their point of system. Therefore, they would also lose the whole system that they operate under. So yeah, this is it for this video. I think the sectors that I picked today will perform in the market next year. Some of the stocks that I have mentioned is worth monitoring and putting on your waitlist to see how their financials improve or how the stock price could drop and you could have an entry. Now remember, in this YouTube channel, I do not hype stocks, I do not overpay for stocks, and I do not ride any wave that is trending. The whole reason why I started this YouTube channel is because this is the type of information that I wish I had when I started investing. When I started investing, almost every YouTube channel was hyping stocks that were overvalued, high PE ratio, and I didn't have a strategy when buying. So if you like a YouTube channel where it does not hype stocks and does not overpay and does not overhype every stock that is trending right now, this is the right YouTube channel to follow and subscribe. And with that, I close it out here and see you on to the next video. Have a nice day.